WPI stands for Wholesale Price Index, which is a measure of inflation based on the price of a basket of wholesale goods. It covers three groups: fuel and power, primary articles, and manufactured products, with different weights. The WPI index tracks the changes in supply and demand in various sectors of the economy. The index is calculated for the financial year that starts in April and ends in March. The WPI index is compiled by the Department for Promotion of Industry and Internal Trade, Ministry of Commerce and Industry, based on data collected from various sources such as market associations, public sector undertakings, and government agencies. The WPI index is released monthly, with a lag of 2 weeks. The WPI index is revised twice, first on a provisional basis after 6 weeks of the reference month, and second on a final basis after 8 months of the reference month. The WPI index is used for various purposes such as policy formulation, economic analysis, price adjustment in contracts, and indexation of wages and pensions. The WPI index is also used as a deflator to convert nominal GDP into real GDP. The WPI index reflects the average price movement of goods traded in bulk by wholesale buyers and sellers. The WPI index does not capture the changes in prices of services or retail prices faced by consumers. In this section, we will look at how WPI declined for 11 consecutive months from April 2020 to February 2021 due to the COVID-19 pandemic and lockdowns. WPI stands for Wholesale Price Index, which measures the changes in the prices of goods sold and traded in bulk by wholesalers. WPI is one of the indicators of inflation in India. The COVID-19 pandemic hit India hard in 2020, with the first nationwide lockdown imposed in March. The lockdown disrupted the supply chains and production of many goods, leading to a fall in demand and prices. According to the government data, India's annual WPI inflation fell for the first time in nearly 3 years in April 2020, to 0.92%. This was mainly driven by a fall in prices of crude oil, energy, non-food and food articles. The WPI inflation continued to decline in the subsequent months, reaching a low of -3.37% in May 2020. The negative WPI inflation meant that the wholesale prices were lower than they were a year ago. This reflected the weak demand and excess supply in the economy due to the pandemic. The WPI inflation remained negative until January 2021, when it turned positive to 2.03%. This was due to a rise in prices of manufactured products, fuel and power. However, it was still lower than the pre-pandemic levels of around 4%. The WPI inflation rose further to 4.17% in February 2021, as the economy started to recover from the pandemic and the lockdowns were eased. The increase in WPI inflation was also influenced by the base effect, which means that the inflation rate was calculated on a low base of February 2020, when the prices were already falling due to the onset of the pandemic. The decline in WPI inflation for 11 consecutive months from April 2020 to February 2021 had significant implications for India's economy. It indicated that the economy was facing a deflationary pressure, which means that the overall price level was falling and consumers were postponing their purchases in anticipation of lower prices. This reduced the profits and incomes of producers and sellers, and lowered the tax revenues of the government. It also affected the monetary policy of the central bank, which had to cut interest rates and inject liquidity into the system to stimulate demand and prevent deflation. The decline in WPI inflation also had an impact on India's GDP growth, which contracted by 23.9% in the first quarter of 2020 to 21 and by 7.5% in the second quarter. The GDP growth turned positive to 0.4% in the third quarter, as the economy gradually reopened and recovered from the pandemic shock. However, it was still far below the potential growth rate of India, which was estimated at around 7% before the pandemic. The decline in WPI inflation for 11 consecutive months from April 2020 to February 2021 was an unprecedented phenomenon in India's economic history. It was caused by a combination of factors related to the COVID-19 pandemic and lockdowns, which disrupted both supply and demand sides of the economy. It had significant consequences for India's economic performance and policy responses. In this video, we have explained how WPI declined for 11 consecutive months due to the COVID-19 pandemic and lockdowns, and what it meant for India's economy. Negative WPI inflation, also known as deflation, means that the average prices of goods and services at the wholesale level are falling over time. This can have various implications for India's economy, such as lower production costs. Deflation can reduce the cost of raw materials, intermediate goods and energy for producers, which can lower their overall production costs and increase their profitability. However, this also depends on other factors such as demand, wages and taxes. Lower profit margins. Deflation can also lower the profit margins of producers if they are unable to pass on the lower costs to consumers or if they have to cut prices to stimulate demand. This can reduce their income and investment levels and affect their growth prospects. Lower tax revenues. Deflation can reduce the tax revenues of the government by lowering the nominal value of economic activities such as production, consumption and income. This can widen the fiscal deficit and limit the government's ability to spend on public goods and services. Lower consumer demand. Deflation can lower the consumer demand by creating expectations of further price declines in the future. This can induce consumers to postpone their purchases and save more, which can reduce the aggregate demand and output in the economy. Therefore, negative WPI inflation can have both positive and negative effects on India's economy depending on the magnitude, duration and causes of deflation. The government and the central bank need to monitor the price trends closely and take appropriate policy measures to prevent deflation from becoming persistent and damaging.